Welcome back to another episode of SaaS Buyers Club. I'm your host, Omeed, and this week we are interviewing Matt Tortora. Welcome, Matt.
Thanks for having me. Excited to be on.
Yeah. So, Matt, tell us a little bit about your background. We'd love to, get some context for what we're going to be talking about today.
Yeah, absolutely. So, I have a background for my entire career in SaaS and technology, but an operator first, and then left the world of being an operator and went to the world of finance and work as an investment banker now, covering SaaS and technology services companies. So with a boutique lower middle market firm out of Philadelphia, BMI Mergers, and I run our software and technology services practice. So all me and my team are doing are focused on and working with SaaS companies in the lower middle market with enterprise values as low as $6-7 million up to $50-60 million plus. So think 3 to 10 in ARR. I've been doing that for 4.5 years and am still actively involved working with SaaS companies as an advisor as well.
Right, great.
My operational background.
Very cool. So an operator. So I'd love to hear a little. I'd love to dig into that a little more. What does that kind of operational experience with SaaS companies look like in your background?
Yep. Well, if you rewind way back to the very early stages of my career, I was in sales employee number one at a project management software firm, Team Dynamics in Columbus, that has gone on to do some incredible things since I left and really dominating in the higher ed space. Also co-founded a software company in Chicago. We ran a product information management software platform, so MDM for product data and information, by the name of ClearStream. Exited that business, went on to be global VP of sales at a venture-backed SaaS company playing in the ESG space, and then ran a consulting firm for a year and a half, 2 years, working with early and growth stage SaaS and technology services companies, helping them implement go-to-market strategies as well as growth strategies. And then decided to move into finance and get into investment banking. And I'm really happy that I have. And it's interesting, like being an operator and then moving over to the world of finance, you start to look at the world differently. And it's, I think, been for me tremendously valuable to have been able to sit on both sides of the table and get varying perspectives, which has been helpful when looking at potential clients, helping clients go to market. Things that I thought were a certain way when I was a CEO might have frustrated me. I fully appreciate and understand now.
That's such an enlightening little point there. Maybe we could touch on that a little more detail now or later. Omeed, go ahead.
Yep. Well, I mean, I'll tell you this, and the headline is it's all about realistic expectations, and I think as ambitious founders that quote unquote dare to dream, I think people can oftentimes have somewhat unrealistic expectations, and I want to be careful not to speak in absolutes. That's not every founder, but I think I know there are a lot of founders that see unicorn valuations and exits and huge funding rounds and think that, well, I'm a SaaS founder, the same should apply to me. And that's certainly not always the case. So I think it's a dose of reality.
Yeah. And we totally understand, that point about being on both sides of the aisle, because Joe and I are also both entrepreneurs that, have founded various companies and have been in CEO roles. So we totally get that both sides of the aisle perspective. And, from the advisory standpoint, how much of an asset that is. Would love to kind of talk about, maybe let's just start the conversation off with, what are you seeing about kind of founder mindset? Like, what is it that founders need to be thinking about when exiting their business, given, that you have the seat from the investment banker perspective?
Sure. So I would look at that in two ways, right? Because an exit occurs either by someone deliberately trying to sell a company and seeking an exit, or being approached by a buyer when a buyer obviously identifies a really good fit. If it's the latter, the seller's not always mentally prepared or in the mindset of an exit. So preparation, of course, goes out the window, and that's more of a tactical exercise as far as managing that process and figuring out whether timing is right, fit is right. But I would say this for anyone who is getting to a place where they're contemplating an exit, you want to take an approach of, okay, we're contemplating an exit, but we're not going to do it. Usually you want to take an approach of, we're not going to do it for at least another year or two, because there's a lot that I think needs to go into planning, cleaning up the business, identifying areas that may be red flags for potential buyers, things that might need to be addressed, like technical debt in the software platform, customer concentration issues, churn issues, all the standard things that buyers will look at. And if there are some red flags, and typically multiple red flags is what can derail an exit process, those are things that need to be addressed, and they usually can't be addressed in short order. It's usually bigger problems that require 1, 2, even 3 years to fix, so a seller can maximize value, increase the number of offers they'll get, and leave in a better position than they would if they didn't address those issues. So I think it needs to be a longer term planning process. But fundamentally, at the end of the day, if a founder builds a really solid company where they're consistently growing year over year and have KPIs that are at or above industry benchmarks, they're going to be in a position to succeed when they do decide to exit.
Yeah, so I hear, that it's a longer term process. You kind of allot 12 months, for
an
the
M&A
process.
Yeah, and look, we've seen companies get offers and sell in as quickly as 4 to 6 months, but at times it will take longer, almost 2 years, and that obviously that's all dependent on A, the M&A environment, B, the DNA of the company, and I'd say C, the sector they're in, because we see more roll-up activity, more aggressive acquisition activity at certain what I would call in vogue categories in software. We'll look at like legacy categories, like call it CRM, ERP, where there's a sea of players and a sea of competitors. Usually that would be a slower process because roll-up activity might not be as aggressive. It might not be a race to get a certain piece of technology to add on with a category that's in heavy growth mode, if that makes sense.
Mm-hmm. And so for most of the deals that you see, though, do sellers typically are they currently thinking that way about exits? Is that the standard way of thinking that you see founders thinking about exits in terms of like allotting 12 months for the process? Are they currently doing that?
It's usually an unknown. Yeah, I mean, it's usually an unknown. I don't think anyone's surprised when we say it, could take 6 to 12 months. And, I try very hard to manage expectations and to a degree under promise, over deliver. So I'm going to obviously err in the side of being conservative from a timeline perspective. But no, I don't. It's more of an unknown variable, but no one's ever surprised because it's a very involved process. So no surprise. And, we see once offers are on the table and someone goes into due diligence, that in and of itself can be a 90-day process at times.
And talk to us about, in that process of exiting, how important is growth, for example, and what are you seeing with respect to like growth rates for the companies at the time of exit?
Yeah, well, it depends on the profile of the company in terms of what I'm seeing as far as growth rates. That also depends on what category are they in, how much funding do they have, because all of those things impact growth rate. But I will tell you this, growth rate is a very, very important variable when it comes to the attractiveness or lack thereof of an asset. And, and it's not spoken, but it's kind of known. When a company's struggling to grow and it's been stagnant to a degree for several years, buyers start to smell blood in the water. And they realize it's an asset that's not growing, and founders are experiencing what I call founder fatigue, right? Lack of capital, probably aren't in a situation where they can go out and raise a substantial amount of money, are struggling to grow, are at, break even or a very small operating margin. and get to a point where they say, okay, we want to exit. It's time to exit the business. Buyers are aware of that. So buyers might like their solution. They might see it as a value add from an acquisition perspective, but they know that given the lack of growth, they could be a little bit more opportunistic. So it definitely negatively impacts valuation. Most of the companies that we look at in the lower middle market that are in the, $4, $5, $6, $7 million in ARR, again, most, not all, are there for a reason, and they're looking to sell for a reason, and that is they've reached a point where they're struggling to grow on their own. They either don't want to or can't take on more capital to accelerate growth and recognize the need to exit in order to get to the next level, which is why most people decide to exit. And buyers know that. So most companies that we see are, growing in the neighborhood of, anywhere from flat revenue growth to 10 and 20% a year. So very modest growth for a company of that size. Usually the companies that are growing 30, 40, 50% year over year are in, as I said before, red hot categories, very well funded, and have no plans to exit anytime soon unless they're proactively approached by a buyer who gives them a can't refuse offer.
As opposed to the ones that, kind of are in a place where they don't feel that there's that's a completely different category than the ones that feel that they can't move forward, for example, or are burned out. And those, the range in multiples between, those two camps of founders, I'm sure, vary differently as well.
That's correct. Yep, that's absolutely right. So some of the biggest things that impact valuation and decide where a company is going to fall in the fair market value range of valuation, growth rate is one of the biggest. Attractiveness and M&A activity in a specific category. And then, of course, all those standard table stakes KPIs, logo retention, net revenue, gross revenue retention, all of those, it's expected that they're at or above industry benchmarks. But yes, without question, growth rate, size, category, all of that have a positive impact on valuation. And, the interesting thing about this is you look at software and you look at the number of SaaS companies, and, depending on where you get your data from, it's anywhere from like 14 to 17,000 SaaS companies. And 80, 90% of those SaaS companies fall into that category of either, brand new and they're not ready to exit, or they've reached that sticking point, that plateau, if you will, of the $3, $5, $6 million in ARR. And there are large incumbents in that category that are chewing up market share. And these companies are really struggling to grow. That is the long tail. And that is most SaaS companies and most SaaS founders.
Interesting. And what are your thoughts, for example, on like vertical SaaS that own a niche with a smaller total addressable market, as opposed to SaaS companies that are like building for enterprise, like a lot of custom solutions. Talk to us a little bit about the what your thoughts are there.
Yeah. So if we look at niche, there's two ways to look at niche, right? There are companies that build solutions that are obviously very tailored to a specific vertical, and the solution in and of itself is unique, right? And then there are companies that are in large categories, like my example of CRM or ERP, but they're not CRM for everyone and everybody. They're not trying to compete with Salesforce or HubSpot. They are building a CRM for dentist's office or a CRM for HVAC companies. Those companies that make the deliberate decision to get narrow, focus on somewhat of an insulated pocket in the market that has a relatively unique set of needs, and say, okay, we don't need a massive TAM. We're not trying to build a $100 million ARR company. If we build a $12 million, $13 million ARR company that exits for 6 times, that's great. Those are usually the founders who are more successful. And if we look at this by the numbers, the likelihood of success taking that approach, that vertical niche focused approach, is a lot higher than the likelihood of being, the next Salesforce, for example, or building a truly disruptive solution that you scale to $100, $125 million in ARR on the back of venture capital. So the only time I ever see the approach of let's go after a huge TAM, let's not be vertical, let's not be niche focused work, is if you're one of the early movers who has access to really good, smart capital and can scale up fast in a specific category. But if you're entering a category that's already crowded and that has 2 or 3 really well-funded incumbents, trying to dominate and win that category, it's almost already too late. And the chances of, and I don't want to say never, but the chances of building a truly transformative, disruptive solution are slim, right? I mean, yes, Salesforce did it when they were really the first true cloud-based CRM company, and they dethroned the incumbents in the market. But those opportunities are far and few between. So my view, Omeed, on vertical niche SaaS is that is usually the best path to go.
I like that.
I mean, it makes sense. An acquirer will come in, they have maybe more resources. Let's say the founder is locked up, they're not able to raise more capital. An acquirer comes in who, has that capital ability and is able to build that niche out, to a bigger market, for example. And that's a, great potential opportunity for that acquirer, right? So that's another reason why it would be a good idea to focus on owning a very specific niche, because it allows for potential acquirers to build out on that strong foundation of that niche that you've established.
Yeah, that's exactly correct.
Yeah,
that's exactly correct.
Joe, I've been hogging the mic here for a second. You got anything for Matt?
Oh yeah, sure. And no, I'm happy to let you guys go over some of those thoughts. One question I did have in my mind a few questions ago was a follow-up, was we were talking about the multiple differences between a business that might not be growing so fast and one that is hotly growing the last year or 2 to 3 years. It is particularly helpful for particularly founders or first-time founders to get a sense of those exact multiples, though I know they can be different on a case-by-case basis. So give us a range of, 1 to 3 or 1 to 4 for a company that's growing at 10 to 20% versus a company growing at 40 to 60, for example.
Yeah, happy to do so. And we've seen a lull, obviously, in the market over the past 12-ish months. If we were having this conversation 18 months ago, the specific numbers that I'd give you would be different. But I would say that where do we see most SaaS companies trade at? Anywhere from 3 to 10. And I realize that's fairly broad. So the question then becomes, of course, what puts a company down at 3 or 4 or 5, and what gets a company up to 8, 9, 10? And of course, there are companies that sell for higher than 10x. There are companies that sell for 20x. Number one is ARR. The higher the ARR run rate, the higher the multiple, the more attractive that asset will be. Number 2 is growth rate. And number 3 is category. I view those as the 3 most important variables that determines where a company is going to fall in the valuation range. So, if you're running a SaaS company that's $3, $4, $5 million in ARR, you're, close to break even, so lower profitability, which would be another variable, or even burning cash, you would be in probably that 3, 4, 5x range. If you're running an $8, $9 million ARR company in a good category, you're growing 30, 40% or more year over year, buyers will pay a premium because that's an asset that's growing. It's a good category to get into. And that's when we see those 8, 9, 10, 11x multiples.
Give us an example of a good category real quick.
I was going to ask the same thing.
That's so funny.
Or a definition of what's the point there when we're saying category?
When I look at, obviously, like the easiest way to look at what is a category, what is not, spend 30 minutes on G2, spend 30 minutes on Capterra looking at categories. What do I define as a good category? From a growth rate, where there's growth and market share to be gained, I look at categories that are servicing, or software categories that are either A, servicing a niche that's growing rapidly, or B, the actual category itself is growing rapidly, which usually is a function of the niche, right? So, for example, today, data and analytics, cybersecurity, those are 2 really sought after, aggressively growing categories. And it fluctuates all the time, right? But those are two really good categories that I like to come to top of mind. What are categories that I don't like? It's naturally overcrowded legacy categories where there are large, well-funded incumbents.
Okay, that is super helpful there. When you first mentioned category, I was wondering, did you mean, though this may be another factor, did you mean having a top position in that category? I see now that's not the case, but is that another factor that's important to you, being first in the category or top 3 in a category?
Yeah, well, without question. I mean, the chances are if you're top 3 in a category, well, first of all, you're in rare air, right? But you were an early mover and you were very, very well funded from really good firms, typically in a specific category.
I love that. Yeah, no, that is super helpful. That it helps give some perspective to sellers. Very often people might not, like kind of you said earlier, if you're dying in a fight in your category, you're not top 3, your growth rate's low, you don't have the cash to fund any potential strategies to fix that, you're not in the best of places. And we often say that founders need to be aware of being in that situation so that they can see it coming, as opposed to get in the swamp, be there, barely doggy paddling for a year or two, get more founder fatigue. Things look even worse on your, if you have 2 years of bad financials versus just a couple months. We try to say that sellers need to be aware of that situation, so that they might just decide to sell when they realize that, okay, in the next 2 years, we're going to have to do XYZ that's different. We don't have the money to do that or the bandwidth to do that. Maybe now is a good time, if the company is good at such time for sale, to seek to sell the business, as opposed to waiting until it's too late.
Well, that's right. That's exactly correct. And I think oftentimes a decision to sell is not predicated on a desire to sell, but more so out of necessity and a recognition of, if we don't sell in the next 2 years, our competitors are going to eat our lunch, and then we're going to be in a worse situation than we are now. That is oftentimes when founders will make a decision to sell. And the truth is, it's the right decision usually when they see the writing on the wall and they decide to sell before it's too late. That's a shrewd business move. If they're serial founders, serial entrepreneurs, it's not going to be their last go out of it. So it's an intelligent approach. I think that not all, but a lot of founders don't give the market analysis and the analysis of the competitive landscape the rigor it deserves, especially at the early phases of a company. I mean, I think sometimes decision to not enter a market and not launch a company altogether is a better decision than the decision to decide to go into a market. And again, that goes back to, okay, if you look at a market, yeah, it could be an attractive growing market, but if there are incumbents that are very well funded and have a high percentage of market share and growing, again, unless there's a huge point of differentiation that actually resonates with buyers, it's usually an intelligent decision not to compete at all.
Wow. That's taking planning for the exit to a whole new level right there.
Yeah, well, it's don't enter, right? So there's no exit if you don't enter. But if you're already in the fire, right? It's okay, how do we differentiate and carve out our niche? Or maybe it's time to exit.
Yeah.
So Matt, would love to just actually, I love the conversation. Let's zoom out a little bit, and so you work as an investment banker. We have a lot of first-time founders that have never had an exit that listen to our show. So let's show them a little bit about when they should know when to talk to an investment banker, what to expect when working with an investment banker, those sorts of things. Would love to kind of look at things from that angle and perspective.
Yeah, absolutely. So as far as what to expect, and I think a good way to answer that question would be, what is the process? What does the exit process look like when you're actually selling the company and going to market? The first is obviously evaluating potential partners and deciding which firm, which group, which person to work with. And I think that decision usually comes down to, or it should come down to, A, what does the rapport look like? But B, who do you feel is going to put the most amount of rigor and thoroughness into the process? For the most part, we all follow the same set of best practices. We all do our homework in establishing relationships with the right acquirers, whether they be strategic or financial. There are some obviously slight differences in terms of how people go about it, but at the end of the day, it comes down to the level of rigor we feel someone will apply to the process. Just like, as you guys know, and being an attorney, you for the most part follow the same best practices, and it comes down to who's going to work the hardest. So it's A, picking the partner, B, it's setting expectations and helping having the investment bank help you understand realistic expectations for exit timeline, how long that you'll probably be in market, a realistic range of valuation. No one should sell you on a specific valuation, because a range is a better approach to this. And what does a realistic deal structure look like? And also setting expectations for what is post-acquisition going to look like. And of course, a lot of that comes down to who you're acquired by, whether it's a strategic, a financial, what does the culture of that strategic look like? So it's setting expectations. Then a lot of material is built. A lot of information is shared and collected around financials, really thorough overviews of the product, and a full 30, 40-page SIM is built. And then a lot of conversations and management calls when going to market. And when you do eventually get that right fit offer, due diligence is a very, very involved process that will require an immense amount of time on the part of not only the investment bank, but the founder too. And look, as our job as investment bankers is to do as much as we possibly can to keep the founder in a place where they can continue to run the business, not spend an exorbitant amount of time on a sell-side M&A process. But due diligence is very intensive process, mentally and physically exhausting, and hopefully it's the only time you go through it. Or if you do go through it twice, it's hopefully with a second company that you exit. But it's the expectation should be to have to spend a lot of time in the back end during due diligence process as well.
Yeah, I think it's important to emphasize there, especially for a first-time founder seller, to make sure that you're leaning on your advisors in that case, because if you're one of those people that wants to be really involved in the process, or do a lot of the stuff yourself, then you can and will get fatigued. And as the months drain on and the requests for this or that continue, it's just it's like working two full-time jobs at that point.
Oh, 100%. One of the things we talked earlier about, okay, what can a founder do to prepare for an exit? And we talk about preparing for actual M&A process, not just the exit. Having really organized financials, having, documents that, are revenue by customer year over year, tracking things like your logo retention rate, your NRR, your GRR, which you'd be surprised, a lot of founders don't have that information readily available. Some don't even know. Usually more mature companies are tracking that in a very rigorous fashion. Just the process year in and year out of having reviewed financials by your accountant, tracking logo retention rate, net revenue retention rate, keeping a really organized CRM and sales pipeline, and understanding all your sales KPIs, that's going to make the M&A process easier, because buyers are going to need to see all of that. And if you already been tracking that information over the past, call it 5 years, number one, you're running a better, cleaner business. And number two, it's going to make the exit process easier for you and easier for the buyer.
100%. Couldn't agree more.
So let's...
Go ahead.
Go ahead.
No, I was just going to say, you'd be surprised at, how many conversations we have with either people who are, kicking the tires on going into market or do go into market. There's a ton of information that needs to be gathered and built out because it wasn't tracked all along. And I get it. As a founder, you have to wear a lot of hats, and sometimes resources are scarce. So doing things like tracking your GRR and your NRR, or having really detailed pipeline reports is not always front of mind when you're trying to win business and stay afloat. But those are all things that will pay dividends both in the near term and the long term.
Yeah, I couldn't agree more. We often see a similar situation, not specifically with those rates, with those quantitative points, but just generally like just not having the financials and for example, the last several months just haven't been put together. It's like, okay, I mean, we definitely need to have that done. A lot of more basic, just fundamental exit ready issues are things we see also. And I think it's a really good educational point just to kind of touch on that, because it is a whole process to sell your business. It's not just, I need to sell now, let's go ahead and call somebody up and list it. That is not the case at all.
Yep. No, that's absolutely right. Yep. Another thing, if we look at like pre-exit prepping, I think, and a lot of companies do this, but regular pen testing of their software, code audits, eliminating technical debt. Again, all things that will come up during an M&A process, but are also good things to do to run a healthy business and a healthy software company that will make the whole exit process a lot easier for a founder. And I guess it's kind of like, to use a poor analogy, but it's like going to the dentist. If you wait until you have a cavity, it's gonna be a brutal visit to the dentist. But if you regularly go twice a year, it's gonna make everything easier.
I think that's a really great analogy, though. Yeah, I hear what you're saying.
Joe loves the medical doctor analogies. He's always making. What's Joe's favorite one? You don't go to WebMD for your medical advice. Hire a real lawyer. Don't go to WebMD.
Don't go to Google for your M&A contract.
Right. So what basically we're saying to founders is, our advice for preparing to exit is eat your broccoli and go to the dentist.
Exactly. That's right. Yeah.
What of our
run a healthy business? Run a healthy business. Go ahead, Joe. What were you gonna say?
We came up with is, when you're selling or buying a multi-million-dollar business for the first time, that's not the time to get your Google Law degree. People love to do that. We had a transaction recently where I think it was the buyer, Omeed, didn't want to engage a lawyer, and we were on the sell side, and it was ridiculous. I'll bleep myself out there. It was just, It's so funny. I don't even want to be near that.
I think one of the things that founders don't realize, and of course it's, we believe in what we do. And sometimes I think people can get sticker shock when they look at, okay, what is an investment banking fee going to look like? What is our legal bill for a transaction going to look like? But the fact of the matter is that those are really investments. They're not cost centers. They can be profit centers in an M&A process, right? So profit center for an investment bank, because you're going to maximize the value. You're going to negotiate. Your investment bank will negotiate for a deal structure that's far more favorable for the founder. And an attorney obviously is going to help mitigate a massive amount of risk, both in the near term and the long term, which of course in and of itself can drive cost savings. So really, if both parties, both the legal advisory team and the investment banking team, are doing their job, they're going to end up netting more capital for the founder in the long run. So to your point, trying to avoid using a legal resource or an advisor in an M&A process is definitely ill-advised.
Yeah, I couldn't agree more. I agree that that very often it's the first time people have seen an attorney bill or engagement for 20 plus grand. I mean, it's not that uncommon. I mean, in America business today, I'm an attorney. I have multiple attorneys. So I don't know. It is what it is. Some people just don't have that experience yet, but it's important to recognize that it's absolutely necessary for an M&A transaction, both to have a banker and to have an attorney and an accountant, of course.
Yeah. And I'd be curious to get your perspective. And the way I view the M&A process at large and the process of selling a company, I think, especially in software, right? A lot of founders look at it as, okay, I want to get the highest valuation possible, maximize valuation, get as many offers as possible. Mm-hmm. But really, in my eyes, the M&A process is an exit in risk mitigation. It's about mitigating risk for the buyer and mitigating risk for the seller. and get them both in a good place where they're going to get not only a fair deal, but a deal that eliminates risk. And for the seller, there's a ton of risk. And you guys obviously know there's legal risk, and I'd be curious to see where you
we'll come back and get you later if you don't have things mitigated.
Exactly. And from a deal structure perspective, we go back to talking about those unicorn valuations, but the devil's always in the details, right? What could be $100 million exit on paper, if you start to pull back the covers, is really, $20 million in cash and X number of dollars in equity and heavy aggressive earnouts. And there's a lot of risk for seller, both from a deal structure perspective, that could eliminate the amount of capital they get. And I always say I'd rather see someone get more favorable deal structure, maybe at a lighter valuation, than some hyper aggressive valuation that is incented with aggressive earnouts, equity, which if you're, depending on the company you're being acquired by, could equal zero at some point. So I look at this more of a risk mitigation exercise than anything else.
Yeah, I agree with everything you said there. To give my response back to kind of just what are my thoughts on this subject from the get-go, to kind of just start off, what would I say in one or a couple sentences is, we always tell people to talk to your attorney right when you start thinking of terms. A lot of people, especially very smart people who run businesses and have the confidence to build a business, sell a product, lead teams and stuff, they're also confident in their ability to think of terms. But that's not really a good thing to do, because so many terms are complex legal terms with their own price tags, just like you're alluding to here now. And so we always tell people, and it is normal in private equity, and it's just super normal to talk with your attorney at first to discuss what terms you want. And there's going to be a lot more things than just the purchase price, and just like if there's a promissory note or if there's an earn out, there's a lot more stuff than just those things. And then as you get down through the terms, then you've done the risk mitigation, you've done the optimizing of what the best deal looks like. Maybe you've even thought of a few different ways you're going to approach offering the terms. So for example, you might have you basically might have your best deal first, but asking a few non-market terms in your agreements and stuff. And then if you can get that, you're good. If not, you have a pullback positioning for various terms. That's how it's done. And that's definitely what we advise. But again, just focusing on getting the best price is a little bit narrow-minded.
100%. Yep, 100%.
I'm going to take the conversation in a bit of a different direction, Matt. I'm just curious, we're seeing some good activity in the lower middle market in terms of just deal activity, and a lot of new players are entering the market and so on and so forth, and like brokers are a thing. I'm just curious from your perspective and for the audience, where should a founder be thinking about using an investment banker rather than a broker?
That's a really good question. And in our world, it's somewhat of a controversial topic. I don't want to say controversial, but if you look at, I'd say in the M&A advisory world, there's really two categories. It's business broker, and it's, investment bank with, an M&A advisory arm. And there's a lot of investment banks that are pure M&A advisory shops. Typically what we see as business brokers is referring to groups or individuals that are selling smaller businesses at smaller revenue run rates, smaller valuations. So, exits and sales as small as $500,000 up to, $5, $6, $7 million on the top end. The other piece of it is licensing, right? So investment banks are FINRA licensed. All the investment bankers at more established, larger investment banks that are doing larger transactions are fully licensed investment bankers, Series 63, Series 79, et cetera, whereas business brokers don't have that qualification. And look, that's not to say that there aren't business brokers out there that aren't professional, aren't well-heeled, and are good at their job. But typically the investment bank is going to have more resources, a team of analysts, a team of associates, access to more market data, deeper relationships, and are therefore equipped to do larger transactions.
Hmm. Yeah.
That's the same way I look at it. I'd like to ask kind of like a random question here. My experience has been that very often business, and not generalizing for all business brokers by any means, because there's a wide variety, but very often it is the case that business brokers tend to see them where it's kind of a real estate broker who kind of just happens to do some business brokerage stuff.
Yep.
Isn't, let's just say, a highly knowledgeable about all the things that an investment banker or let's say a highly ranked investment banker or knowledgeable one would know. Is that also your experience?
Yes, it is. The other thing I would say too is most investment banks or investment bankers are specialized in one or a small handful of verticals, which makes it far more dangerous and effective when it comes to running an M&A process, whereas most business brokers are generalists, and especially in software, because I think software is a very unique breed of company, and there's a different set of metrics, a different way of evaluating an asset in software that is not common in other industries. So especially in the software world, it's really important to work with someone who has experience selling a software company.
Yeah, I couldn't agree more. There's definitely idiosyncratic issues just for those sales, and also the process isn't the same either. I mean, there tends to be a different focus, different players, different ways valuations are looked at, different expectations. Like you were mentioning a little bit earlier in the due diligence side, you're going to have to check certain specific things regarding the software, tech debt, etc. And I don't mean to call out brokers when I say this. We know a lot of great brokers, and we respect them. But very often, we see brokers in those type of situations just not acknowledge the issues.
Yeah, and not only that, look at it. So again, and to your point, not to call out business brokers, but a generalist doing smaller deals is almost certainly not going to know about, how ARR growth rate and gross revenue retention, net revenue retention, number one, what they are, or if they have to actually build those models out for clients that don't have them, they won't be able to do that. And then if you look at the complexity of software M&A, it's one thing to sell an HVAC company that's doing $7 million. You'd say, okay, well, we're going to go regional and we're going to find a list of 200 HVAC companies in the Piedmont region that are doing $20 million or more in revenue and can make this acquisition. That doesn't happen in software. It's got to be very specific. It's, understanding the category, who are the players in the category that would be interested in acquiring an asset, what are the adjacent categories where there'd be synergies. That nuanced level of knowledge in a specific market is incredibly important in software. And it's something that a smaller generalist is almost certainly not going to have.
Yeah, 100%. And just to kind of, I guess, reel it back a little bit on the, when I differentiate between the two, I really do look at them as different services, even though, they can service the same client or the same deal. But I do look at business brokerages as being typical for those smaller deals, maybe more generalist transactions, just as we're mentioning here. If you're in a small town and you happen to have, like we had a deal recently, like a painter shop. Actually, I don't remember the broker on that transaction, but I'm just using it as a hypothetical anyways. I'm not trying to refer to that transaction. But if you're selling a small painting company and there's a local broker who does businesses and real estate, and it's like a couple million ARR, it's just, it makes a lot of sense for that broker to be on that transaction is what I'm saying. I'm not trying to say that investment bankers in all cases are better than brokers. I'm trying to pull that sentiment.
Right. They're better for a specific segment of the market.
Exactly. Yeah. That's what I was trying to get.
And the truth and the fact of the matter is, they are probably 30 to 40 boutique, lower middle market focused investment banks that have done a ton of software transactions. And so it's not like there's a shortage of firms out there that know what they're doing in the space. Mm-hmm. So, and I highly doubt there is, but if there's someone listening to this podcast that has a $4 million landscaping business, they should by all means find a good local business broker. But if it's someone running a $4 million, $5 million ARR software company, they need to spend the extra amount of money to invest, no pun intended, in an investment banker.
Yeah, great. I'm really happy we kind of rounded that off there just to make clear how we're differentiating them to kind of even out the side for the brokerage wide people. Brokers. So, Omeed, I feel like you have something on the tip of your tongue.
Yeah, something I like to do sometimes is like, Matt, imagine that Joe and I are SaaS founders who are struggling to grow and, can't raise capital, and we come to you and we're like, we're ready to sell our business. Where are we going from here?
Well, first thing I would do is I'd want to look again under the covers, right? So I'd want to see financials for the past 3 years. I'd want to see revenue year over year, revenue by customer. I'd ask for those table stakes KPIs that we talked about earlier: logo retention rate, net revenue retention rate, gross revenue retention rate. I'd also want to see things like, are there sales KPIs? Is there a pipeline? What's your average annual customer value? All those standard SaaS metrics that we can pull from a million different sources and are well publicized. I'd want to analyze all that. I'd want to analyze all the financials. So and then what I want to say is, okay, what do you think your business is worth? What are your expectations on valuation? Because oftentimes people have a number in mind, and it maybe he's not thinking, okay, this is what I think my business is worth. It's more a function of, this is the amount of money I want to get at an exit. And that's usually predicated on the lifestyle they want to lead. What do they want to do next? Do they have a certain financial goal in mind? Maybe they're approaching retirement age and they need a certain amount of capital to live on, have done financial planning. Maybe they're early stage and want to move on to the next thing. So I'd ask, okay, what is your expectation on valuation? What do you guys need? And give it an earnest look and an earnest response around, okay, do I think that the profile of your business will meet or exceed your expectations? And not only do I think it can meet or exceed exit expectations, but do I feel there's a greater than 50% chance that we'll be able to hit that? And if the answer to that question is no, obviously I would tell you, no, you've got to grow and you got to get to this specific number. If the answer is yes, we would start working on putting all that information together, identifying the buyers that we think are going to make sense to engage with, again, both strategic and financial, build out all the materials, fully understand your company. And that's usually a 5-ish week process, and then go to market.
That's great. I love that because, I love that because you're starting off there with, is this business sellable? And is this person able to or willing to sell this business at what the market price would be? Now, if I were to come say again, we're in that hypothetical, and I come back to you and you think this business could be sold for at most $6 million, and I tell you, hey, I need $12 million for this business. How would you respond back to me in an educational way in that situation?
Yep, I would tell you, because this is usually almost always the answer, is you're not ready and you need to grow. And I would shoot to get the company to an ARR range of X to Y. And then at that point, you'll be in a position to hit, meet, or exceed that $12 million number. And my recommendation is almost always to get it to a point where the ARR number they reach would make hitting a $12 million valuation a slam dunk, right?
I see. As opposed to a reach,
correct.
Just kind of getting
I never take a company to market when it's a reach. I say no more than I say yes. And the biggest reason I say no is because exit value expectations or exit value goal is not aligned with what I feel the market will bear.
Yeah, that makes sense. I mean, from that perspective, you basically are saying or thinking to yourself, this business isn't going to sell.
That's right.
At such rate.
Most all businesses will sell, right? Unless...
I just meant, at such rate.
That's exactly...
with the market.
Interest. Yep. And the truth is, like I said earlier, the M&A process is an exercise in risk mitigation. I view it, for me, in terms of the time investment that I put into the process of selling a company. Of course, I've got a great team supporting me, but it's a huge time investment for me as well. So we have to look at this too and say, do we feel we're going to be successful? And we're of course not successful with every M&A process. No investment bank is, but we want to make sure that we have got a really good chance of meeting or exceeding those expectations.
I agree, and I have something to throw out there real quick. Here, I'll be just one more second. I'll say one more thing, kind of within this hypothetical. So if we were wanting to or considering selling our business later, would we reach out to you well in advance just to start the conversation and set our own expectations? Do you usually encourage people to do that? If so, how does that usually happen? I guess I'll leave that.
That happens all the time. And we're always willing to jump on a 30-minute call and, get a sense of the high level numbers, what they're looking to exit for. If it's, a longer term, call it 12 to 24 month process, educate them on what needs to be done to prepare the business. Sometimes we'll do more formal engagements too, where we actually get involved and roll up our sleeves and actually help implement those things and do a full financial analysis of the business and really dive in to do copious amount of work and examination of the business to really help them prepare. But yes, I would absolutely recommend that someone go through the process of speaking with people who know the market to help them prepare. One mistake that I see occur frequently is people will pay for a third-party valuation, and usually I don't put a lot of weight into those, and here's why. Sometimes they're accurate, but the market's going to dictate the value of the company, and by far the best exercise for valuing a company is doing precedent transaction analysis. It's it's not a DCF model. It's not a combination of 3 or 4 models. I mean, yeah, of course that stuff holds water, but without question, especially in the lower middle market, it's understanding, okay, in this sector, most companies are trading at this. And your KPIs will push you a little bit in this direction or a little bit in that direction. And that, quite frankly, usually has to occur by talking to your investment bank.
Yeah, I love that. That's extremely helpful because some people do. There are a lot of those tools online, I guess. I mean, we used to do a lot of startup finance, startup corporate work also in addition to M&A, since corporate and M&A are in the same bucket for attorneys. And so, we would always have to deal with those valuation services. Haven't looked at them recently, but a lot of people kind of just Google valuation stuff.
Yep.
There's all sorts. What I've tried to say is there's all sorts of options out there.
Well, the problem with the Google exercise is the valuations you'll see is the press releases on company X that's sold for 12 times ARR. And founders will say, well, they're in my category. It could be broad, right? Well, they're a data analytics solution too, and they sold for 12 times ARR. We should sell for that too. And that, we talk about expectations and not being aligned with reality. There's so much more beneath the surface that they just don't know, right? That company could have been growing 50, 60% year over year, and their solution was a perfect plug-in in a really competitive subcategory of data and analytics that drove this huge valuation. So there's so much beneath the surface around those transactions that you just don't know about it. So the Google exercise of, what are data and analytics software companies selling for really does not do a founder, it does a founder a disservice.
Yeah, it's a tough one because people kind of want to know a quick answer to a very complicated question.
It's right.
That you need an advisor, a professional to come in and sit with you on. A lot of people want that 5-second result from Google.
Yep.
People always ask us, we say go talk to somebody else usually when people ask us. Depends on the vertical. If we did some recent deals in that vertical, we'll comment, and then we kind of have our general commentary too. But as lawyers, that's not really our place to comment on it all. Omeed, I've been kind of hogging the mic there. I'll throw it back to you.
I love it. I love this conversation. It's awesome. So, Matt, talk to us about kind of some of the struggles that you see with SaaS founders in terms of realizing, the exit they want. What's kind of one of the biggest things that you see there?
When you say struggles in terms of realizing the exit they want, it sounds like you're referring to not being able to achieve it, or just getting to that point.
That's correct. Yeah, not being
Yeah,
able to achieve it.
and not to oversimplify this, but they don't grow to a meaningful revenue run rate to hit the valuation that they want. And I don't mean to sound, this is not meant to sound negative, but
Yeah.
a lot of people think that their technology will get them a great valuation. Slap on $2 million in ARR. We have this awesome technology, so we therefore deserve this great valuation. And 99 times out of 100, that's not going to happen. Yes, there are companies that get insane sums of money because they have a truly transformative product, a deep IP. It makes a ton of sense, and there's a lot of synergies for an acquirer. Yes, that does occur. So it's a fallacy to say it doesn't occur, but it's also a really grave mistake to think that their technology will get a super high valuation. And I think there are two types of founders, and in software, it's either a technical founder or a sales-oriented founder. And usually there's, if there's a co-founder, you will hopefully have one of each. But I think by their nature, technically oriented, engineering background type founders are more focused on product and less focused on sales and revenue. And they're real deep in the product to the sacrifice of revenue growth. So, but by far, the number one thing I see is a lack of enough ARR to hit a valuation that they want. The market doesn't pay for bells and whistles and cool features, and buyers don't pay for that either. The market pays for growth. And what's interesting is I'll talk to people all the time and say, well, our software solution is better than, pick whatever incumbent you want in whatever category. We do this better than they do, and our support's better than theirs. Again, the market doesn't care. The market cares about how much market share are you consuming, how much noise, how many trees are you shaking, how fast are you growing? And that's the hard thing, right? It's a grind. It's a ton of hard work. Scaling a SaaS company is one of the hardest things you can do in business. And I know this from experience. So the reason almost every founder doesn't hit the exit valuation they want is they haven't grown enough. And that's, quite frankly, an answer people don't want to hear, but it's the truth.
And I feel like it's so different than I think one of the things that makes SaaS such a sexy area of business is everyone thinks that it's so much easier to scale because the overhead is lower, for example, because you don't need as much for example team support or OpEx infrastructure, for example, outside of a team of 2 coders, for example, and a sales-led founder. So I feel like the kind of forward-facing thing for everyone is oh, SaaS is a gold mine because it's easily scalable, infinitely scalable, so on and so forth. And so it's kind of a harsh reality and truth to hear that actually maybe it's not that way.
Well, I think one of the things that a lot of people don't realize about SaaS is SaaS is now a mature industry. And it's not just a mature industry, but it's an overcrowded industry. And the barriers to entry are getting lower and lower every year. We're entering into low-code, no-code era. It is now easier to spin up and scale a product, get an MVP into the market by far than it was 15, 20 years ago. And so it's become very crowded and hyper competitive. And those are unfavorable market dynamics. Look at Porter 5 Forces, right? Low barrier to entry, high competition, feature focus with little points of differentiation. And especially in coming out of this year, and there's a report that just highlighted this, downward price pressure, higher customer acquisition costs. All those variables, all those competitive forces make scaling a software company extremely hard. And to your point, Omeed, people think it's a gold mine, and it can be a gold mine. But like anything, if you want to strike gold, you got to work a lot harder. I talk to so many companies in the IT consulting, IT services world that will build a product internally to deliver solutions for customers. Maybe there's a front end that customers can use. and they get shiny object syndrome when they want to migrate over to the software world because they see these huge valuations and think they're going to build a $60 million company. And I always tell them, don't do it. Stay the course. Yeah, great. Build a software product and run a hybrid software services company, because scaling a SaaS company is extremely challenging.
But it sounds like what I'm getting from this conversation is, if you're thinking about starting a SaaS company, focus on a very specific niche with a smaller TAM, really own that niche market. As a founder, be focusing on customer acquisition. That's incredibly important. If you do those things and maintain your growth, you're going to really build a business, that can grab those multiples that you're looking for.
And just for clarity, niching unless you're literally creating a new market product category.
Correct. Which is very, it's, I think it's great for people that try to do that and who are successful. I applaud them. I've never been able to create something that heavily differentiated, or had any kind of idea along those lines. But for those who are able to do that, those types of founders will exist forever, and there will be new ideas that come into the market. But it's extremely challenging to do that. The better is build something for a very specific niche that has a unique set of needs and just own that niche. And that makes scaling a company a lot easier. Or if you're going to be truly disruptive and you have a really unique product that is validated with demand, then that's another way to really scale. That's right. Yep. No, look, don't get me wrong. I think I sometimes can, it sounds like I'm painting this gloomy picture of no competitive market, and it is, but software is awesome. I love software. It's created a tremendous amount of wealth and will continue to create a tremendous amount of wealth. There are new needs, new categories, new ways of looking at the world that are emerging all the time. So there's a lot of great. It just needs to be viewed, especially the exit process in building a company. People need to look at it in a different light than they would have 15 years ago.
No, and by the way, it only seems gloomy because it's realistic in a hyper optimistic marketplace.
Yep, that's right.
And so I definitely, from my perspective, don't take what you're saying as gloomy. It just it goes back to, I guess, that operator versus financial experience perspective. In the financial world, this is just kind of basic stuff. It's like, if you have the numbers, it's investable. If you don't, it's not investable.
Yep.
Product's going to get chopped up by somebody else. Because it's a hyper competitive, for example, niche. Why would I want to buy it? Buy that business, not the product. So I totally see what you're saying there. I do hear also what you're getting at, though, is if it's a very excited founder or somebody looking to get into SaaS, for example, then we're not trying to demotivate them, more so just tell them what's going on.
Optimism that's grounded in reality.
100%.
That's our motto.
Yep.
That's the motto.
Look, I think it's the nature of a lot of software founders and technology entrepreneurs. It's the desire to try to change the world. Great. It's the desire to build something huge. That's fantastic. But I think a lot of that can be, there's blinded optimism, I think, sometimes.
And don't fall in love with your product.
No, and that's a huge mistake I see a lot of founders make. It's the nobody thinks my baby's ugly. They'll, I'll hear a lot of, we have better features here and better, as I said earlier, better customer service, whatever. Sometimes no one cares. I think it's great. You should strive for that, for sure. But, if you look at this, I think it's important to have perspective, not rely on perception, because a founder's perception of their product is very different than if they tried to step outside of themselves, step outside of the company, and look at this from a standpoint of broader market perspective.
Couldn't agree more.
And it's like, if founders just, what I see from founders a lot is like, oh, I'm never going to sell, I'll never sell. And it's actually that perspective that prevents founders from really understanding the true value of their business, because if they were even open to selling and considered it and yeah, I mean, that perspective is so contrary just to planning for the exit from the beginning as well, which is another way that founders can really make sure that they get the best exit value for their company. But if you think I'm never going to sell, I mean, that's just a really kind of defeatist perspective to hold in terms of just making sure that you're going to get the best value for your company
Agreed.
when the inevitable does happen.
Yep. Agreed. And I think there's a lot of options. I think that founders, and I know we're going to talk about private equity in a little bit too. There are a lot of options that founders have at their disposal, and you know, capital events, exit events that they don't even think about. I think most think about, you know, again, we're going to build this company that's going to be $400-500 million enterprise valuation, and we're going to sell it for a huge sum, et cetera, et cetera. By the numbers, it's of course it's possible, but by the numbers, it's a very slim chance of achieving that.
Yeah, 100%. And there's definitely one thing I always whine about. I'll say to Omeed is people get too attached and have too much self-identity with their businesses, and you know, it's really just I know it's a harsh way to look at it, but it's really just a big asset that you're over-invested in so many scenarios. And you kind of just need to have that third-person perspective as to what's it worth. What other things should you be doing with your time? If you have founder fatigue, we very often see people when they're retiring sell businesses or when they're burnt out. And it's like nowadays, you know, you could have a little more foresight than wait for those events.
Agreed.
What are you seeing in terms of deals, in terms of what SaaS founders are actually getting at the time of exit, Matt? What can you share with us in terms of any insights there?
When you say what they're actually getting at time of exit, I'm assuming you're referring to like deal structure, what percentage are they realizing in cash versus equity, et cetera?
That's correct.
From most of the transactions that I've sat in on, it's been a majority of cash at close. Typically what I'll see, and this is a function of both offers and transactions, strategics are less willing to, so a strategic buyer, i.e. a larger player in a category, are less willing to pay in a cash heavy deal and are a little bit more conservative with cash than a private equity firm. So in a private equity deal, I'd say 80 to 90% cash is a very realistic expectation, with also the expectation that the founder will roll over a portion of their equity into the new entity. Whereas with strategics, you know, I think that an expectation of around 60 to 70% of the transaction being cash and the remainder being some form of an earnout or equity is a realistic expectation. But without question, we see a higher percentage of cash at close in the SaaS than we do in the IT services, IT consulting world, just because of the IP, the nature of recurring revenue. It's far less risky for buyers than if you're selling, you know, an Oracle consulting firm or an SAP consulting shop where it's not contractually booked recurring revenue. It's a little bit riskier, so we see heavier earnouts, less cash at close in that world.
Got any horror stories for us, Matt, in terms of, you know, we always like to ask for horror stories just because those are the ones that are off. Go ahead, Joe.
No, I'm just trying to give a little context there, like deal gone wrong.
Well, I mean, I've seen that happen more than once. I mean, if you think about, and you guys obviously as M&A attorneys know this, there's a million things that can derail a transaction. So if you look at it by the numbers, right, and you look at how many things can be a deal killer, sometimes it's amazing a transaction even gets done ever, right? I don't think, though, a deal not getting done is a horror story because the chances of it happening are high. So you accept it and you move on to the next buyer and keep running your process. To me, what is the real, I guess, tragedy, not to be too dramatic here, but the real tragedy is not what happens during the M&A process, but post-acquisition. And I think that the home you find for your company and for your employees and for yourself and the culture and the environment can really make or break you long term. Now, granted, you may get your capital and you may be financially taken care of, but selling to the wrong organization, one that is not a fit either culturally, one that, you'll get buried in a hierarchy and there will be bureaucracy and internal politics, which will derail your asset, maybe prevent you from hitting an earnout. That's the real risk and horror story, if you will.
Yeah, I like what you're... Oh.
Do you have a story where that may have happened, for example? And
you don't
did
have
you
to
see it? Yeah, you don't have to name names.
Yeah, obviously I want to be really careful and respect the confidentiality of my clients. And I would tell you this. This is what I feel comfortable sharing.
Sure.
You have conversations obviously we have conversations with buyers all the time, and then subsequently our clients will have conversations with the buyers. You can tell pretty early on in an M&A process and in due diligence what the culture will be like, and is our client going to be going to a good home? And I think a lot of that comes down to how fair and how collaborative are the buyers during that M&A process. And you can glean that pretty early. That's usually emblematic of the culture of the organization you'd be potentially selling to.
That's a good point there. I like that, kind of just getting the feel at the beginning from the talks to determine if there's going to be a cultural fit. Kind of going back to a little bit. So, and we're totally cool, by the way, on the confidentiality. Our key intent here with horror stories is always to drive at a lesson learned. Sure. And I feel that's very clear here, the lesson. It's not to talk about anything in specific. Now, actually, I want to ask again, do you have any other big lessons learned from particular experiences? Maybe just one more lesson or something?
I'll speak, and this is germane to SaaS because this has been an issue. Customer contracts. So I've seen,
okay.
You guys, of course, will like that, right?
Yeah.
I've seen
both our eyes lit up like, wow.
I used to have heart buttons so fucking much when people stop paying attention to it.
I've seen customer contracts in a transaction become a huge issue, and it was uncovered at the later stages of the due diligence process. And there were some, perceived issues with the strength and the validity of those contracts in terms of the way they were constructed. And concern on the part of the buyer around the ability for someone to exit those contracts, which almost killed the deal. So that right there in and of itself would fall into the category of, a quote unquote horror story, right?
Yeah.
But it's emblematic of something that's bigger here. And that is sharing as much information as humanly possible and getting as much out on the table as early as possible. Because if you go 80% of the way through a due diligence process and you've burned both time and money on legal expenses, accounting expenses, third-party code auditing expenses, et cetera, usually the buyer will cover that. But regardless, you get my idea of expenses. And then towards the latter stage of the transaction, there's something uncovered that kills a deal. You've invested now a lot of time and a lot of money with nothing to show for it. I think what the worst part about that is there could be so much fatigue coming out of that, both financial and time, that the seller may just take the company out.
I see. I want to add a little bit of meat to that and talk a little bit about the contracts, but I want to see if it was there anything you were finishing up or I'm just
no, please go ahead.
So I was going to say is, yeah, that's totally a big issue. So very often people think, the commercial agreements are the furthest thing from their mind when they're considering whether or not the target is viable. And so when it comes to those commercial contracts, the most important points to look at are, as you mentioned, the termination provisions. Are they actually locked in? On what terms can the customer just volitionally terminate on 30 days notice or no days notice? The termination provision. All these provisions have standard market expectations for what they're supposed to be at. Another one is the warranty provision. Another one is the indemnification provision. And another one is the limitation of liability provision. These are the 4 biggest provisions. Not that they're not all important, and it does vary. Maybe there's a ridiculous uptime guarantee service level in the service level agreement for the SaaS business. So on a case-by-case basis, the important terms do vary, but nonetheless, these are 4 of the key most important provisions that should be taken, a look should be taken to. And it's not always the case it's done. That's kind of a good reason why hiring an M&A attorney is super important, because they'll know what to expect in the commercial contract due diligence part of the transaction. You know,
it goes back, I think, to our earlier conversation about a lot of rigor when building a company, or like, from an accounting perspective, and you could say from a legal perspective too, and bringing in the necessary resources to run a very clean, very professional organization.
Yeah, 100%. And I will throw one more thing out there, which is that, you know, if the company just doesn't have all their commercial contracts set up appropriately, they haven't been rigorous in that area, it is not necessarily the end of the deal, because, for example, they may be able to roll out a clean, I mean, it could take months, but they could roll out, depending if they want to click wrap it or not, because there's issues with click wrap enforceability, depending on the jurisdiction, but they could roll out new agreements to their SaaS customers and report it back to the buyer and say, okay, we have, you know, if it's a company that just literally has crap agreements, they roll out appropriate ones. That might be enough to resolve the issue, but that might take too much time. That's definitely something that needs to be considered in the moment.
Yep.
Joe has another saying that's his favorite. That's you don't go to a family doctor when you need to go to a cardiologist, and I feel like that conversation can be summed up there with that saying, kind of along the same lines of like WebMD is not valid medical advice. We have like all these kind of little sayings. Do you have any sayings that you love? Do you have like a favorite saying, Matt, that you go to? Yeah.
Well, to pull from Glenn Ross, maybe coffee's for closers, but
I do love that. I love that one. That's a
right?
classic. As he sips his coffee.
That was by design, Omeed.
That's
awesome.
Yeah, I like that.
Yeah, so we got some horror stories. By the way, love that customer. Yeah. Was it like a big enterprise customer contract, or was it just curious?
It was ubiquitous across all their contracts.
Okay, cool. Gotcha.
Not
what about some other some other like harsh truths about selling a SaaS company? You got any other like hard hitting truths for us, Matt? We might as well get them out.
I would say as far as some of these harsh truths, they don't happen all the time, but they're common patterns and themes that we see, right? So the first is, again, to our earlier point about deal structure, right? You see the sticker that other people sell for a valuation of X. And the truth is that a lot of times that doesn't come to fruition. And even though they sell for a certain valuation, there are a lot of stipulations, earnouts, notes, equity, all kinds of things that could take a $25 million valuation and the founder could end up with, half that at the end of the day. That would be harsh truth number one. Harsh truth number two, and I see this risk more with large corporations who are acquiring a company. Your product's going to, I don't want to say disappear, but it's going to be buried in a sea of, other features and other modules within a solution. There's a lot of bureaucratic and political risk to things like hitting an earnout. And so there could be some post-acquisition struggles, and founders are going to have to stay on and be embedded in an organization for quite some time. So that would be harsh truth number two. And again, harsh truth number three, what we talked about earlier, product's important, right? I mean, I'd be a fool to say someone, it's not important to build a great solution and have great customer support. But the harsh truth is, the one thing that moves the needle the most at the end of the day is ARR and ARR growth, and that's the hardest thing to do. And it's not what founders want to hear, but it is the harsh truth. And that is the single biggest thing that will help founders from an exit perspective.
I think that's super helpful. And harsh truth or not, it's the truth, and it's just what people need to know.
Yep.
This business. And again, going back to another thing you said earlier, just it helps set expectations so that when people do go to sell their business, no one's surprised at all and everybody's on the same page. I didn't mention, but I almost said earlier, I had a similar experience early on in my career when I was still I was late teens, just hit my 20s. Started my first business, and I just didn't see that. I didn't have that perspective yet of, okay, these numbers are what's important. Your product plan, though important, is an add-on. Like, it's just kind of a thing that gives people some knowledge. But again, just the difference in learnings that one can acquire from being an operator versus being straight up in finance and just seeing what's important in the finance industry and from a buyer's perspective.
Agreed.
Yep. Who knew? Sales are one of the most important aspects of a business in terms of.
Omeed loves sales.
I do love sales. I do. Sales makes the business. Who knew, man? Who knew?
All right, revenue. Who would have thunk it?
Right.
When you're a tech founder, though, and you just committed, I just kind of play devil's advocate on your comment there. I mean, though it's not
go for it, man.
If you just spent 6 months building a product, I can understand why, and it is the case that so many of these engineer operators just think their business is worth so much because it's like, oh, I built this amazing thing that very few people could build and very few people have. Of course, it's worth $50 million. It's like, well, you haven't even started getting really big enterprise contracts yet. It's simply not worth that much on the market. And I can see that why they have that perspective. And it's not a
correct. Yeah.
That's true. Yeah, and I mean there's something to be said about building cool things. It's just like, do people want whatever it is that's cool that you're building? That's like ultimately what it comes down to.
They want the revenue, not necessarily the technology.
Yeah. But Matt, let's talk about private equity and SaaS. How are founders thinking about private equity currently, and how should they be thinking about it?
Most of them are not, and that's the surprising thing. And it's, most like lower middle market, again, like that 5 million-ish ARR. There's a huge opportunity for founders, and private equity in the LBO world is continuing to grow. And private equity firms love software companies, given the recurring revenue, given the high gross margins and the scalability of the organization. And for founders, it's an opportunity to get 2 or even multiple, like 3 and 4 bites of the apple, if you will, and go through an exit, leverage the infrastructure of a larger organization, more capital, bring a greater level of or greater degree of professionalization to their organization, and rely on a team of advisors who will be able to lend some outside expertise and look across their portfolio and their experiences and be able to implement some best practices. So it's an opportunity to really scale our organization with access to resources that they wouldn't have had before. It's a totally different path than the venture capital path. So there's no dilution. There's an opportunity to take chips off the table today, roll over meaningful equity, and again, scale with a greater degree of resources and support. And it's something that, surprisingly, because founders, I think, in software are so focused on venture capital and growing a business that way, private equity is an often overlooked option for founders. And so once a company reaches, 5, 6, 7, 8 in ARR, that's a very real possibility. and there will be a lot of opportunity out there. When we talk about those niche markets, private equity is, most private equity firms don't want to take a company and build it into $1 billion valuation. They want to find a company that is playing in a category or in a market with favorable dynamics, that's somewhat insulated, and that can scale maybe not 10 or 20x, but 4x, 5x over the next 6 or 7 years. And that creates really meaningful outcomes for founders, both at the outset from an exit and taking some chips off the table and de-risking things in the short term, but also more upside, even potentially a greater degree of upside on a second exit 5-6 years down the road. And there's, as I said, a whole swath of private equity firms that love some of those companies that are playing in those less competitive categories. And the independent sponsor world now is growing as well. And you've got a lot of really small, very effective investment firms with access to good capital that love that niche approach to software too. So it's a great option for founders that are in that position where, okay, they've gotten to 5-6 in ARR. There's a good opportunity from a strategy perspective to stay in an insulated market, or even make a slight pivot into a more insulated place within their category, and access to capital and providers that will be on board with that strategy. So I think, again, a lot of people think, okay, we've got to raise $10 million of venture funding, then get to the next round or to the next round. And there's a really good option for those founders that maybe that ship has sailed.
Yeah, that's such a good piece of advice. When founders, and I know you have a follow-up question on me, but I want to ask real quickly, founders are pretty familiar nowadays, though they weren't necessarily 25 years ago. They're super familiar nowadays, by and large, of around the world they are, how to approach VCs. How do they approach PE? I'm obviously asking something we've covered in some part here, because we talked about, well, how many PE firms are particularly are in SaaS in the US, et cetera, but kind of just give me the down low on the answer to that.
Or we look at, because we still look at it as an exit, right? Because they're exiting like 70% of the business, right? It's not just a pure capital raise where there's dilution or there's debt. It's, there is a partial exit. So we still look at this in our world as an M&A process. It's different than selling outright to a strategic acquirer, but it's still an M&A process. So my answer to that question would be, they would oftentimes private equity will approach them if they look at the profile of the business and it's in a market they want to play in. It seems to be the size they want to go after. But I would say if a founder's at a place where they want to go and shop their company to private equity group and they feel they're large enough, ideally 5 ARR or higher to do that, an investment bank would be the vehicle to get in front of those buyers or those acquirers.
So you're saying reach out to an investment bank and start an initial call, is what you're saying.
Yeah, look, you could, a seller could absolutely go to a private equity group, especially one they knew, directly and say, look, we want to explore options. But usually that's an investment banking led process.
No, totally. I'm just trying to put some
absolutely
clarity on the picture. That makes a lot of sense to me. People are so used to preparing pitch decks when they go start doing a roadshow for VC firms. Would you, if you were an IB, just first hearing from somebody who's potentially floating the idea of selling your business, would you expect them to prepare any materials for you, or would you say, hey, just get on the phone, have a firm grasp on be able to spit out what the numbers are, obviously, but you don't need to go prepare a fancy deck? What would you expect on a first call like that?
You mean with a private equity group?
Oh, no, I'm sorry. If you were a founder who was thinking of going the PE route instead of the PE route, should you prepare any docs for that first call or not?
No, I would view the first call as an exploratory conversation and just a high-level sharing of information.
So it's pretty easy then to take that route and just start talking, as opposed to you don't need to sit down and turn it into a giant exercise. You can start feeling it out pretty quickly.
That's correct. Yep.
I think that's super helpful for founders who are already busy enough to, if they don't have M&A experience, we're M&A lawyers, so it can be easy to take for granted, just having that information at hand, but most people don't, and it's a pretty big exercise. So for business owners out there to know that they can just pick up the phone and start a conversation and figure things out without having to spend several hours is super helpful.
Yep. No, that's absolutely the case. And again, and not to beat a dead horse, but if they were serious about going through a private equity process and they knew they wanted to do that, again, I would strongly recommend professional representation, both legal and obviously investment banking representation, to run a process and give it the rigor that it deserves, without question. But I mean, look, private equity firms are always out looking for good opportunities because that's their world, that's their business. So, again, but I would not recommend a SaaS founder that's south of $5-6 million in ARR and doesn't have solid KPIs from a retention perspective in place to entertain that process.
Yeah, makes sense. Makes sense.
Yep. But it sounds like you also believe that founders that are at that 5 million, 10 million ARR milestone still overlook private equity.
Some, not all, but yes, without question. There are a lot, and it's surprised me that have really never given that route serious consideration or even know all that much about it. I mean, there are some that were absolutely educated on that. I'd say probably it's a 50-50 split.
And what do you Go ahead, Joe.
No, I was saying it is, I like how you're calling that point out. It just makes so much sense to call out that people should be more aware of the optionality. Omeed, back to you.
Yeah, and I'm just curious if you have any insight as to like the mindset of the founder that overlooks it. Like, what is the cause for overlooking it?
I think it's primarily a function of the fact that when you think of SaaS and you think of capital, you think of venture capital without question.
That's true.
That's the common line of thinking. And I think it's also a function of most founders are heads down in scaling their business and don't have the luxury of, out running a ton of conversations with people like us and getting a broader perspective on options, the capital markets in general. But again, there are some who are very well educated and will come to us and they know exactly what they want to do, and private equity is one of those options they want to explore. And usually it's a function of the fact that private equity firms have already been in touch with them.
Makes sense.
Yeah, totally makes sense. Well, Matt, we're at the recording time, so I want to leave you with one last question before we go to close here. Just a tip of the day. So we've covered a lot of really good information on our recording today, but if you have like a summarized one tip that you would love for SaaS founders to take away, what would you say that one tip is?
Revenue growth cures all. Without question, revenue growth cures all.
Yeah, I picked that up. Focus on the growth.
Yep.
Focus on the growth, and that'll get you the results. Yeah.
Yeah. Maybe I shouldn't say cures all, but it cures.
I got what you meant.
Oh yeah, I know what you mean too. It makes a lot of sense in the context.
Yeah. Awesome, Matt. Well, thanks for joining us for another episode of SaaS Buyers Club, and we're definitely going to link all of the contact information, like your LinkedIn and your email and all that stuff, in the show notes. So if anyone wants to reach out to Matt, just check the show notes for his contact information. That we'll collect all that stuff from you and put it in the show notes. Is there anything else that you would like people to know in closing?
I don't think so. I hope I did a good enough job distilling a lot of information in the last 90 minutes. So
you did. It was wonderful. It was a really good episode.
Yeah, but again, I enjoyed it and enjoy your show, and appreciate you guys having me on. It was a pleasure.
Yeah. No, 100%. So where would people, especially if it's whether or not it's a founder who's exploring the idea of selling their business, where should people reach out to contact you at? Do you have a website you want to just name?
You can find me and through BMI Mergers and Acquisitions and bmimergers.com. My personal website, matttortora.com, and of course on LinkedIn as well, which is a really easy way to get in touch with me, which obviously I know we're going to provide those links.
Great. So people can reach out to you on your personal website, your LinkedIn, elsewhere. That's super helpful to leave us with. So that was kind of the only thing I wanted to check off before the end here.
Perfect.
Cool. Thanks everyone for joining us. I'm your host, Omeed. And this week we had a fantastic conversation with Matt, and we'll see you again next week.